Good afternoon again, everyone. My name is Mary Awoni, and I'll be moderating today's session. So today we're going to have, our topic is on capitalization table and startup valuation. Last week, on Friday, we had a topic on startup founders fits, and we're told how to get founders, that's co-founders for our startup, depending on the stage at which our startup is, and if it's necessary to get those founders and the necessary skills and experience and characteristics to look out for. So today we're going to be having an experienced entrepreneur speak to us. He's a founder of different businesses and different applications and stuff like that. And he's also an award winner of multiple awards. We'll have Mr. Ikechukwu Okoli facilitate today's session, today's topic for us. So, Mr. Ikechukwu, good to have you in our midst, and over to you. Please note, if you have any question during the session, note it down so that at the end of the session, you can ask all of your questions. Thank you. Mr. Ikechukwu, over to you. Thank you.
All right. Good day, everyone. Thanks for showing up again for this session. Today we're going to be talking about capitalization tables. I believe this will answer some of the questions that were raised in the last meeting, because some people had raised questions around equity, around co-foundership, and the things related to ownership, and then timing as well. You know, what happens if this happens to ownership, and you know, how do you go about defining who should get what and things like that. This would throw more light on that. It would help us drive home some of the points that we began making last week on Friday. Okay, so it's capitalization table, which is usually pronounced in short form as cap table, and startup valuation, understanding ownership and valuation in startups. What is capitalization table, or cap table in short? Definition. A capitalization table is a document that outlines the ownership and equity distribution in a startup, including shareholders, their respective ownership percentages, and things like that. So as the word goes, it's simply a table, usually an Excel table, you know, an Excel sheet where you have information about those who are owners in the company, how much percentage they own, and the corresponding share value of that percentage that they own, you know, in a business. Towards the end, we will show us like an example of this, and so we can see what the details are like. Why is this important? This is important because the cap table helps us to keep track of who owns what, you know, who has lost what, who is gaining what, you know, and then how much the company is valued at per time, you know. So this is what it helps us to do per time, you know, because if you want to get new investment, definitely your investors will ask you, who do you already have, you know, who owns what, how much is their contribution, how long have they been with you, and things like that. So this cap table generally just gives all of those information that we'll be asking. Components of a cap table. So what are the things that you should typically see in a cap table? What are the items that must and should appear in a typical cap table? Number one is founder's equity. So for a startup, this is a must. You know, it would be the first thing that you see there as a founder of a business. You definitely have a stake. I mean, you didn't start the business for the sake of charity. You started the business because you wanted to own something. You wanted to work for something, and be proud to own that you've worked for, you know. So the first would be the owner's stake in the business, you know, and any usually it starts with 100% when the owner, if it's a single founder, it will start from that single founder owning 100%, or if there are two, it will start from both of them owning 100% of that startup, maybe 50-50, maybe some other kinds of ownership arrangement or ratio. So the next we expect to see is employee stock option. So this is usually a small percentage, maybe between sort of 2 to 10% of a business that a founder or founders allocate to their very key staff. And these staffs are usually like maybe inception staff. So staffs who started with the startup from day one. In some cases, these employees may have salaries. So if the business has some cash flow, fine, they could earn some salaries, you know, but at the same time, the idea of giving them this equity is to ensure that they have a skin in the game, that they feel that they own the company. Because for a company that is just starting, you want people to be able to stay with you long enough for you to build out stuff, you know, so you don't want people coming and then leaving after 1 month or two. You know, so number one reason for that is you want people to stay, you know, so they can stay long enough with you for you for your business to stand, you know, to have sufficient revenue to then be able to hire more people or pay people better. So and then again, that's the first reason. The second reason is that you usually, as a startup, don't have all the resources to pay them market rates. So you don't have the resources to pay them what maybe a Zenith Bank or UBA or Share or NNPC will pay them. So as a way for compensating, it's a way of compensating and covering up for the limitations that you have in being able to pay them going market rate, you give them some equity so that, I mean, if they look at their pay and look at the equity that they have, they feel like they are well compensated, at least relatively. They feel like they have a reason to do their best for you. You understand? So that's the idea around employee option stock. It's a small percentage of that whole 100% that you set aside, you know, for your employees. The third thing that one would expect to see, depending on what stage you are with external money, so external investment and stuff, is preferred stock. So this is equity issued to investors, e.g., venture capitalists that carries additional rights, preferences over common stock. So preferred stock is usually what venture capitalists would ask you for. Why is it called preferred stock? Because it's stock that has some privileges attached to it that other types of stock don't have. It is preferred in the regard that, you know, when it comes to paying dividend, when it comes to paying, you know, paying rewards to those who have invested in your business, these people have first have an upper hand. So they will be served first, they will receive their dividend first before other persons, you know, before holders of other types of shares or stock. And in the case of liquidation, when the business is folding up, they have a right to recoup their pay as much as possible, you know, from the existing assets. So if you're shutting down your business, they have a right, you know, to be able to recoup some of their investment from anything that is left of your business. So let's say your cash has run down, but at least you have some vehicles, you have a building, you have some assets, you have some inventory. They have the right to try to recover some of the monies that they've invested, you know, before the business run down. So if they take and there's nothing remaining for other types of stockholders, that's fine. It ends like that. You know, but there are ways, of course, of ensuring that this undue disadvantage that they have does not in any way affect the business adversely. You know, so there are ways to correct that. We won't go into that unless anyone wants to know. Common stock. So common stock is the last type of item we expect to see in the cap table. So common stock is just regular kind of shares, and the founders, employees, are usually also the kind of people who should have this kind of stock. And what happens, why is it different, or how is it different from preferred stocks? Different in the sense that it doesn't give you that sort of first line privilege as the preferred stock, but holders of this type of stock, particularly the founders and employees, have a bit of an upper hand in terms of how company finances are managed. So for instance, the employer is the founders who will define or determine whether they want to pay a dividend at any time or not. So even if they've made money, they might decide that this is so small that they don't want to pay dividends. And in that regard, even though the preferred stock owners have a right to earn dividend first before other types of stockholders, they would not be able to influence that. So common stockholders are, it's just the way it sounds common, common in the sense that they are the people typically in the regard of revenue or dividends. They're the ones who get their dividends after the preferred stockholders have gotten theirs. Okay. And in terms of voting rights, preferred stockholders typically don't have a voting right in a business because they have there's less risk that they are taking in a business. But somehow, depending on the kind of agreement that you have with the people, the entities who own this common stock, it might be different. They might ask for voting right as well. They might even ask for the right to be able to veto decisions. So it's become really fluid in the startup space, how this the interplay between the common and the preferred stockholders. Startup valuation definition. Startup valuation is the process of defining or determining the worth or economic value of a startup. So it's a process of determining how much is this startup worth. There are different techniques for doing that. We'll see those in subsequent slides, but it's just a way of determining how much a startup is worth. Factors that affect valuation. Factors such as market size, growth potential, revenue projections, team expertise, competitive landscape, and industry trends influence startup valuation. So let's just take them one by one. And market size. So if your market is large, if your product in the market is very large, it's very likely that you'll be more or higher value than businesses operating in a smaller market. So if your market, for instance, is let's look at some of us who are in business. What are the kinds of businesses that we are in now? I can't remember. Can anyone tell us what business they are in here? Any of the participants, so I can pick up from that to make an excuse and to make an example. Excuse. Kelechi or Innocent or who else? Lucy.
I'm into salon work, like beauty, salon stuff,
Okay,
fixing up
spa.
hair, yeah, spa, everything that surrounds that.
Okay, so that's good now. So imagine that, okay, you're in that beauty space. So from spa to massage to manicure, pedicure, makeup, and all of those things, So that's a fairly large market. Now imagine you in that market, which it's not an entirely female team, but imagine that it's a female team. You're talking about the female population of a certain age, maybe from their teen to somewhere in their 60s or so, who are going to patronize you, and of course some male as well, spa and things like that, massage. Now compare that to someone who is in the business of, for instance, let's say someone who is in the business of let's say someone who repairs shoes. I don't know if that's a good comparison. I'm looking for someone who is in maybe a slightly smaller market, for instance. Okay, let's say someone who is in the business of repairing laptops, for instance. You can compare these two markets, because how many people own a laptop? Let's consider a city's economy. How many people own a laptop in that city? Compared to how many people would want to do manicure, pedicure, makeup, spa, and things like that. So if you operate in a market that is large, it's very likely that you will be valued higher than someone who operates in a small market. And the reason is this that for someone who operates in a large market, it is assumed that there is a lot of room for growth. It's assumed that there's a lot of room for growth. There is more space to grow. There are more customers to serve, in other words, and then there's more money to make. So you're likely going to be more highly valued, as a business, when investors are considering who to invest in, because it means that there's more space for you to expand and more people to serve. Growth potential. If your business is in a sector, or your business is growing at a fast rate compared to another business, it's easy for an investor to see value in your business, and want to invest in you. So what it means is that between a space of 2 years, for instance, you have the capacity of moving from 100,000 per month revenue to 10 million or 20 million per month. If you compare that to a business that has the capacity of moving from that 100,000 to maybe 500,000 in 2 years, the fact that you have a higher growth potential means that you are going to grow bigger and have more valuation than the guy who grows small. And that the whole idea of growing small might not entirely be something that is specific to the business. It might just be that the sector is like that. The sector does not really lend itself very easily to high growth. So imagine someone who is in, say, someone who is in construction business, for instance, or someone who is in agricultural production business. Compare that person to someone who is in fintech. Even if you invest the same amount in these two businesses, the guy in fintech has a higher possibility of growing faster than the guy who is in farming. Because imagine farming, no matter how fast you want to be, you need to wait for the crops to grow. You can't hurry the crops into maturity and into harvesting. But for fintech, you can hurry customer acquisition, you can hurry sales, you can do promotions, and you multiply sales and revenue. But you can't do that for agriculture, for instance. So just by the nature of that industry or sector, it doesn't lend itself easily to very fast growth as you have in other sectors. So these things influence the way that investors, value a company. Revenue projections, they're also related to growth. We talked about that. Team expertise. If you have a team that has more experience in a particular area that they're operating in, it's very likely that investors will see high value in your business compared to a business that has guys who haven't got, a lot of experience like that. Competitive landscape. If you operate in a market that is highly competitive, where there are already well-established big guys in that industry, you have a lower rate of succeeding than someone who is in a place where there are not many very big competitors. So if, for instance, you start a business and what you want to do is to compete with Coca-Cola, a whole Coca-Cola, then investors will look at you as we don't really know what will happen with this guy, because you want to compete with a very big brand that has everything. It has name, it has history, it has expertise, it has experience, it has spread, it has infrastructure, it has funding, it has network of distribution, of distributors, retailers, acceptability, a lot of things, so you are likely going to be considered a risky business, if you want to step into that. In that way, that would also affect the way that you're valued as a business. Industry trends influence that. So industry trends, if you're in a sector that everyone is saying, maybe projections from government and experts are suggesting that, hey, this sector will definitely grow in the future. This sector will grow. Everyone is predicting that. Government policies are aligning with ensuring that that sector grows. You're likely going to be high valued as a business compared to someone who is in a different sector with not very encouraging projections and trends. It's like the time when we began to have smartphones. So if you want to go into a business, say like 15 years ago, at the time when we're beginning to experience the rise of smartphones, smart cameras, smart calculators, all of those things. If you were in the business, or if you got into the business, into that sector like 17 years ago, and your plan was to build analog phones, it would be considered a very risky venture, because all of the reports at that time, all of the trends in that industry is pointing to the rise and the dominance of smartphones and not analog phones. So if you are in that sector, you're likely, and you want to start building analog phones, your valuation before investors will be very miserable, because they see a trend in which the world is moving away, or the market is moving away from what you want to start producing. Valuation method. So we talked about valuation, and now we're looking at how companies can be valued. So there are three popular ways, and some other new kinds of trends that accountants or finance people are bringing up. But the three most popular ones are these here, and we'll talk briefly about them. The first is comparable analysis. Compare the startups to similar companies in the industry based on financial metrics and market multiples, or transaction comparables. So this is a method in which you look at two companies, who are in the same sector, who have a similar kind of history in terms of how they started, how many customers they had, what their revenue were like, and what their valuation like. So let's say, for instance, you have company A that is valued at 5 million right now. They are valued at 5 million. Their monthly revenue is 500,000 per month. They have 52 staff. They've been in existence for 5 years. What else? So yeah, these three metrics: staff size, revenue, monthly revenue, then of course the evaluation, and then their age, 5 years. And now you're a new startup, you're just 1 year, and you want to value yourself. Comparables helps you to look at that older startup and say, if this startup is valued at 5 million after 5 years, with 1,500,000 monthly revenue, and I am 1 year and I have monthly revenue of say 100,000, and I have around 10 staff. If you compare the two of them, you will see that my revenue now is around 20% of what this 5-year-old company is, valued at 5 million. If you look at their staff strength, my staff strength is somewhere around 15% or 17% of what they have. With this comparison, you can roughly come down to say, okay, we are somewhere around 15 to 20% of this older company that is valued at 5 million. So we are somewhere around say from 1.5 to so we are somewhere around say 750 to 1 million in terms of valuation, looking at comparing ourselves with this one that is older. Another way to look at it is to say, okay, this company that is now valued 5 million at this point, at the time when they were at our stage, when they had revenue of around 100,000, when they had between 10 to 20 staff, what was their valuation like? And that may not be very particularly correct, but it's a starting point. So if you look at that to say what was their valuation at the time when they were at our level, and then you use this other one that I used about looking at the percentage of their revenue and your revenue and see which one is higher. You might choose to pick which one is higher. But the idea is that if the markets haven't changed significantly, it's likely that these two would probably be the same. Not the same, but at least somewhere relatively within the same small margin of difference, plus and minus. So this is what comparables do. They are very standard accounting templates around that, but this is like a general explanation about what that is. Discounted cash flow. So this is the most popular of the three. What it does is that it calculates the present value of the future cash flows by considering revenue projections, growth rates, and discount rates, So we're going to look at a formula in the next slide that talks about these kind of valuation. But what it does generally is to say, okay, if we are making annual profits or annual revenues, if our annual revenue is maybe like 500,000 per month, per year, and we are projecting ourselves in the next 3 to 5 years to have annual revenues of around 3 million. That's 3 million in the next 3 years. So that's say 3 million of 2026. What is the value of that 3 million of 2026 now in this 2023? The thinking of this is around the time preference around finance that assumes that 3 million now that you have in your hand is not equal to 3 million in 2026. So what you're trying to do is when you do your projection to say, okay, I'm earning 500 per annum now as revenue, but in the next 6 years, I'm going to be earning 1 million per annum. What is the value of that 1 million of 2006 now? It's usually likely that 2026, that 1 million of 2026 is worth less than 1 million today. It's most likely that 1 million of 26, if you look at it in terms of today, that 1 million is what maybe like 800,000, 850, 750. How and why is it worth less? What determines how less it's worth compared to what it should be in 2026, which is 1 million, is the discount rate. And that discount rate is a combination of a lot of things put together. It's a combination of, how risky the environment is, the economy is, the combination of potential costs for credits, cost of capital, that's things like interest rates, put together. And for those who use this formula, there's a standard discount rate that is usually associated to an economy based on, cost of capital, interest rates, inflation, and country risk and things. So these are things we will not go into, but just to give a general picture of this kind of valuation values your company based on your projected revenue and cash flow. Based on your projected revenue and cash flow. So if your projected revenue is likely going to be very high, if you're going to be growing fast in the future, then you're likely going to have a higher valuation if you use this method compared to someone whose projected cash flow would be small. Good. The third one is venture capital method. Estimate the startup's value based on expected return rate and expected exit valuation for the investor. So this is a kind of valuation where there is a bit of discretion is used here by the investors themselves. And this is typically the case if you are a very early startup company where you don't have a lot of revenue. Even if you have revenue, it's not very clear. So maybe it's a revenue of like 1 or 2 years. So it's not like a company that's been there for like 20, 15, 5 years, where you can see a clear history of how the company is growing and you can project. So usually when you're very early stage, 1 to 2 years, it's not very clear. You don't have a strong history upon which to make projections. So it's usually the case that venture capital investors would use their discretion to determine your value. And the key things that they look at is expected returns rate. So what they are looking at is, if I invest 100,000 today, what would likely be the return in the next 5 years from this company? Looking at your revenue, looking at the expertise, looking at your market, what will likely be the return? And they are also thinking, okay, I have a projected exit time, so I want to pull out of your company in the next 5 years. And when I'm pulling out in the next 5 years, anything I put, I want to see like 3 times that value. So if I'm putting 100,000 today, I want to leave with, say, I want to live with like 10 million. With like 1 million. So that's times 10 of what I put. And so they are looking at your company, you are saying, in the next 5 years, what is this company likely to what? What would it likely give me, in the next 5 years when I want to leave? And they are using that calculation to determine how they should value you. If they look at your company and see that, okay, if I put 100,000 now, in the next 5 years, I will likely get 10 million. It means that in the next 10 years, in the next 5 years, you should be worth 10 times what you are worth today. Because that's the only way they can get 10 times of what they've put in there. If they are putting 100,000 now, they want to get 1 million. So they want to get 500,000, which is 10 times. Then it is expected that your company would multiply in value by 10 times in the next 5 years. If looking at your details, your sales, your market, your team, they think that you can grow like that, then that would help them determine how much they should value you as a company. But if they think, see, in the next 5 years, we don't think this guy can grow that much, then it will make them reduce the valuation of your business. So if they will look at it today to say, okay, if you say this guy is valued at 1 million, in the next 5 years, can it really, based on what we are seeing, is he able to produce, like, would it be able to rise to 10 million in valuation? Because if they don't think you can be 10 million in the next 5 years, then it will be overpricing you to say that you are valued at 1 million now, in their thinking. And some sort of rule of thumb that they also use is to look at your revenue. Sometimes, they look at your annual revenue to say, okay, if your annual revenue is 500,000, then you're likely, in terms of valuation, we might be able to value you at maybe 2.5 of that amount, times 2.5 of that amount, or maybe times 2 of that amount, or times 3 of that amount. So the whole venture capital method is just looking at your valuation based on how much they want to get from you, how much they think they can get from you, considering the time they want to pull out of your company. Okay. Valuation. So we're now looking at this second one here, this discounted cash flow method. So this discounted cash flow method is just a way of saying, if this is your projected cash flow, and then we are discounting that cash flow by a certain amount, as R in this case, and then that gives us this amount, which is, the value now of your projected cash flow of 5 years. This is the value now. The 5 million of the next 4 years, this is the value. All of these things put together when we sum up all these discounted cash flows into the future, then it gives us an idea of how much we should value you at this point as a business. So imagine this business, for instance. Let's say this is the cash flow that is projected for year 1, year 2, year 3, year 4, up to year 5. And at the end of the day, this is a discounted cash flow. So this is nominal cash flow. This is discounted cash flow, and this is the net present value of the business. So what this will do, what this valuation method will do, is to look at this discounted cash flow, do a summation of this whole discounted cash flow, and then place the company at this valuation, which is 15 million. So in practical terms, if your cash flow in 1 year can be 1 million, and it will rise to 2 million next year and rise to 5 million the following year, and rise to 7 million in the 5th year, then when we discount all these discount all this cash flow by a certain discount rate based on inflation, cost of capital, interest, and things like that, then your discounted cash flow would give this 15 point something million, which is eventually how that business is valued. Which is eventually what that be. So if you look at these now, if you add these up here, this is 1 million, this is 3 million, this is 8 million, this is 13, this is 20 million. So the whole cash flow is somewhere around 20 million for the next 5 years, but it's discounted by this amount here, discounted by this rate here, and then it gives 15 million. So this type of valuation would put that company at this valuation level. It will sum all this discounted cash flow and get this 15, and it will roughly put the value of that business or that startup at 15 million. At 15 million plus. So if someone is investing, if someone plans to invest 15 million in that business, the person is looking at that investment based on this valuation, and that's like the person is buying up nearly the whole company. So this valuation here helps you to know how much you should be able to get from investor per time. So if you know from calculation that this is your valuation, roughly 15 million, you can't be expecting somebody to invest 15 million in you, because like that's your entire business that the person is taking over. So if you value at 15 million, you probably want to say, okay, I want to give out a small percentage. Maybe I want to give 10% out to get 1.5 million. I want to give investors 10% of my company and then get 1.5 million in investment, and then you move on with that. Or maybe you won't want something less. Maybe you want to give out only 5%. That will be 750 million and $750,000. So this is like a rough kind of estimate of how this looks like. There is a standard Excel template usually that helps to do all of this, but I'm just giving an idea how this discounted cash flow works, because that's the bedrock of this discounted cash flow method of valuation. Pre-money and post-money valuation. Pre-money valuation is your value before investment comes. And post-money valuation is your value after an investment has happened. So maybe before an investor put money in your company, you're valued at 1 million. That's your pre-money valuation. And after they have invested, say, 250,000 and taking 25% of business, your valuation rises to 1.25 million. That becomes your post-money valuation. So we're looking at some other terms again: dilution and equity financing. Dilution, the reduction in ownership percentage of existing shareholders due to the issuance of new shares or securities. So let's say you are a sole founder and only you owns 100% of your company. If someone comes and invests in your business to take 10% of that company, you are no longer the owner of 100%. You're now the owner of only 90%. That process, that thing that happened that made your ownership to move from 100 to 90 is dilution. And dilution happens when you bring in new capital and then give out equity or give out shares from your company. So that's called dilution. Equity financing is the process of raising funds by selling equity or shares. So if you raise money in your company by selling out some of your stake, some of your share, then that's equity financing. Factors influencing startup valuation. I think we've talked about this nearly extensively, but we'll talk more about it with this and this. So before we talked about market size, growth rate, revenue, expertise, team, and things like that. Now there are additional factors that affect how a startup is valued. Market opportunity. Again, this is what we already talked about. Revenue and financial performance is like what we talked about. But the new thing here, I think team expertise, we also talked about that as well. So like the guy now who is in this beauty space, if you have within your team, maybe your co-founder is someone who has 20 years in this business of care, of beauty and care. Someone who's managed a spa that makes a lot of money in Lagos, Abuja, or abroad. You have a strong expertise within your team, and your valuation as a business will be very high. So that's just to add some more context to that. But more specifically, the new thing that's been added here is patents, trademarks, proprietary technology that provides a competitive advantage. This is the major boost to valuation. So imagine in your beauty business, instead of buying from existing beauty care consumables and materials like artificial nails and cutters and things like that, you now have by yourself a new kind of formula, a new kind of technology that helps you to produce very high quality nail polishes or artificial nails at a very low cost. And that gives you a high level of advantage within the market. That intellectual property, especially if you patented it with the laws in Nigeria, for instance, or anywhere you operate. I think there's an agency within the Ministry of Trade and Investment that does registration of patents. So let's imagine that you now registered this new idea or technology, with the office responsible for registering patent. Investors will very highly value you as a business because they see that you have a technology that will give you a high level of competitive advantage within the market. You have a technology that will give you an edge because it means that you will very easily make profit within the market regardless of what the competitors are selling. You are going to be able to sell, the same thing, but with higher profits because your technology has enabled you to produce the same thing at a lower cost. So you would be valued higher in the industry compared to other businesses. Exit strategies and liquidity events. So now we are looking at how investors eventually get their reward and leave your business. Because many investors, particularly venture capital investors, are investing in your business to make profit. They want to invest in you when your valuation is small, so that when your valuation grows and they pull out their share from your business, they will be pulling out a higher value for themselves. Let's say, for instance, you are valued at 100,000 and they invest 10,000 in you to take 10%. And now, after 5 years, you are now valued at 5 million. That 10% they invested the first year when you are valued at 100,000. Now that you are valued at 5 million, that 10% is now worth 500,000. So imagine moving from 10,000 to 500,000. That's why, and that's what investors invest in businesses for. Particularly early stage investors like VCs or angel investors, they want to put money in you when you are valued at a lower price, so that when you increase in value and they pool their money, they come with a massive profit. So if you look at that 10,000 compared to 500,000, that's like, I mean, that's like 5,000% increase. That's like 5,000% increase in value for them, you know. So that's what exit looks like. And there are different ways that businesses or that these investors exit your business. One of the not very popular way, you know, it's IPOs, because it takes a lot to get to IPO. IPO is the process of offering shares to the public through a stock exchange. So you know about the Nigerian Stock Exchange, New York Stock Exchange, the Johannesburg Stock Exchange. So this is a case in which a company grows very big, you know, that it's now a brand that the public wants to associate with. And in that case, instead of talking to one or two investors to raise some cash with them, they go to the stock exchange, and anyone who is a member of the public from anywhere in the world can buy directly from that company through the stock exchange. You know, we know about Dangote, all the banks in Nigeria, UBS, the Net Access, GT, all these guys are quoted on the Nigerian Stock Exchange, and you can buy their shares. So one way for investors to pull out of your business is for you to get to that stage where you can offer your shares to the public. Let's say, for instance, this same example, you are worth 100,000, a business invested 10% in you, and you know, another business invested another 10%, and after 6 years, you know, investors have invested in you such that they now own around 70% of your business. And one way for them to exit, which is the one we are talking about, is IPO. When you go to IPO and you say, okay, I'm now offering 70% of this business to the public, what happens is that these investors who invested in you started investing in you when you are only 100,000, and then moved to 200, 1 million, you know, and maybe at the time you are going to IPO, you're already worth like 100 million, you know. These investors, some of the investments they made at the time you were 100,000, 1 million, 5 million, 20 million, would have multiplied. And now what the IPO does is to say, okay, this 70% that we have bought from your company at maybe 1,000 per share, or maybe 5,000 per share, 1 million per share, you know, now that you are going to IPO, these shares are now worth 2 million per share. You know, these shares are now worth, sorry, that 2 million per share is way too much. Let's say 2 million for each percent. So you could have like 5 billion shares you want to sell. But these people began investing in you when 1% of your company was worth 1,000. And then later 1% was worth 50,000. And later 1% was worth 1 million. And now you want to go to IPO, you want to bring members of the public to buy your share at the time where 1% is now worth 5 million. What happens is that 70% that they've bought over the years that you are now offering to the public, they will offload it. So the public will come and buy that 70% at the rate of 1% being worth 5 million. In that case, from the people who started buying when 1% was worth 1,000 to people who's buying started when 1% was worth 10,000 to when 1% was worth 100,000 to when 1% was worth, they will now make massive profit because they are now selling to the public, all manner of people, thousands and thousands of people, buying small pieces of this, at a time when 1% is now worth 5 million. That's a description of an IPO exit. Not many startups get to that point, but it's a very highly desired stage where, it's no longer you talking to some investors to invest in you. It's actually about the public buying into your company. That's where Coca-Cola is. That's where Google, that's where Facebook and all these guys are in. I don't think Mark Zuckerberg owns up to 20% of Facebook today because it's gone public and many people have bought, those shares that some few people invested in like 20 something years ago, at the time when Facebook was not as valued as it is today. Acquisition, selling startup to a larger company or competitor. So acquisition means, many of us probably remember the case of Paystack, who started as a small startup in Nigeria and then eventually got bought by Stripe at $200 million. It's the biggest startup exit in Africa at the time it happened. So what it means is just the same case that we are talking about. People starting investing in you when you were just 100,000 valuation, when 1% was 1,000 to, when it increased. And then, how they exit out of your business, how they pull their investment out of your business with returns, with profit, with rewards, is when you now are bought by another company. So you started at say 100,000 valuation. Now you are valued at 100 million, and a company comes to buy you for 100 million. So all the investors who've been investing in you at the time you are very, very small and coming up, they will now reap higher benefit, from what the investor, this new acquirer, the new company is acquiring you, is giving to you. So the difference between IPO and acquisition is the IPO is the public mass, amount of people, in their thousands and millions sometimes are coming to pick bits and pieces. But in the case of acquisition is one company coming to buy up your entire asset and buy you over as a company, and then investors pull out with profit for sure. Secondary market, selling shares to private investors or participation in a secondary market transaction. So this is the case where you as a business, you are not going to IPO, you are not being acquired, but somehow you are easing up your shares in small amounts, through some legal structure to investors on a very private note, so like private placement in a sense, where you have a couple of investors who just come and, on a very one-on-one level, they buy shares from your company, but you are not in IPO, you are not selling your company. So this happens literally all the time. And it's usually not public, it's just like something that happens on the ground, in the boardrooms with those kinds of exchanges, that kind of thing, Okay, so conclusion. We've talked about the cap table, we're talking about regular updates, concepts like dilution effects and all the other things around your startup. Thank you very much. If you have questions, let us know.
Thank you so much, Mr. Ikechukwu. Thank you for breaking it down to our understanding. I'm sure we all now know how all the topics connect to each other and where we're to start from and how the capitalization comes about, the capitalization table comes about, and also when it comes to exit strategy and all that for your business. Mr. Ikechukwu, thank you. You really did a great job breaking it down for us. At this point, anyone that has a question, either pertaining your business or your idea, and you're thinking, okay, how do I go about this when it comes to that, my capitalization table or my exit strategy, what should I do? You can ask your question now. If you've jotted anything down, this is the time to ask your question. If there was any point at which you felt lost or you didn't understand a particular part, you can also ask now. Thank you. Any question? Innocence, Providence, do you have any question? Or you totally get it?
Or should we now ask them questions as well?
Yes, we can. I thought you wanted to show them a sample of the Excel. I don't know.
Yeah, I'm trying to pull that up. I'll get it. I'll get it.
Okay, okay. So Innocent, pertaining the last question you had, you asked during the last session, I'm sure this also threw more light to your question, right? In terms of getting co-founders and what to offer them and stuff like that. I hope this shed more light to your question.
Yeah, it does. Very.
Oh, thank you. Providence, please, can we know your type of business? Providence, if you can hear me, you can unmute your mic and speak. Let's know your type of business or your startup or your idea, depending on the stage you're at. Okay, in case where you are is also noisy, you can drop your answer, your response in the chat box.
Okay, so let me ask many of us in the meeting here. Okay, so Providence, I think someone dropped. Okay, so I was wanting to ask, can anyone tell us what dilution is? What is it? What is dilution? Providence. I think the other person dropped as well. What is dilution? What leads to dilution? When does dilution happen? While I pull up the Excel.
Providence, I don't know if you can hear us. I don't know. Providence seems not to be responding. Maybe his audio is not clear or something. I don't know.
All right. So let me go through this Excel, like I said. So let's say this is your pre-money valuation, your valuation before money came in, before an investor came. It's pre-money valuation, so it's 500,000 naira. And now you raise 100,000, which is like 10% of your business. No, not 10% here. It is 20% of your business. Now your post-money valuation becomes 600,000. That becomes your pot money valuation, and this happens after you have sold 10% of your business in this regard. Now, this is the total number of shares you have. You have 1 million shares, and after investment, which is 100%, but after you've invested, after an investor has come in to invest 100,000 in your business to now take 20% of your business in that regard. It should be 20%. now take 20% of your business. Now the new post-investment shares now increases from 1 million shares to 1.2 million shares. And out of these 1.2 million shares, the shares that have been sold from your business was 200,000 shares that have been sold from your business. Remember, we start from pre-money valuation, 100,000 investment, and then post-money valuation of 600,000. After this 100,000 was added to it, and you've lost or you've given out 20% of it, and that 20% is amounts to 200,000 shares that you've given out. Yes, from 1 million to 1.1 million. Now let's look at the cap table with the founders, starting with, or the founding team, starting with 100 million shares of common shares. Remember common stock that we talked about here. That's where you have, founders, employees, that's the kind of share that they have, And now you have an investor X invests out of these 100,000. It was broken down into these numbers. First, preferred shares, this 100,000 was shared into 50, 25, 25. You have first, the investor X brought in 50% and took this amount, which is 5. And another investor brought in 25% and took this percentage ownership. And then the third one brought in 25,000 to get 2.5% of the entire shares of the business. So if you put all this together, this is 10% of the ownership of the business that have been taken by this investment of 100,000 into that business. The total amount of shares that were acquired moved from the total amount of shares is 200,000 shares, like we put here, and then the ownership that was given out or that was seeded for getting in these 200,000 or getting this 100,000 into the business was now and 10%. And so this is what the cap table now looks like for the business. I think this should be 10% here. Do we have any questions? Providence, if you have any questions or comments on these explanations, you'll of course get the video on YouTube for sure. But if you have any questions now, fine, we can let you know, or you can let us know.
Okay, I think Mr. Ikechukwu, you explained it really well for us. Thank you so much. I don't think Providence has any question. He hasn't sent any message or raised his hand so far. So thank you so much, Mr. Ikechukwu, for this awesome explanation. I actually personally also learned something new, so thank you so much. Our last topic for this session, the whole cohort, is going to take place on Friday. So after that session, we're going to all have our one-on-one session on Monday. I'm going to relate the message in the WhatsApp group. And after that, the graduation will take place on Tuesday by God's grace. And we'll wrap up the program and you'll all be graduated and inducted into the alumni network, where you get further information and get to network with like-minded founders like yourself. So this brings us to the end of today's session. Thank you so much, everyone, for making our time. Thank you, Mr. Ikechukwu, once again. Do have a great day and see you on Friday. Thank you.
Yeah, thank you very much. Yeah.
Thank you, Mr. Ikechukwu. Thank you.